Hello, Jason Bates here, owner of Electrum Financial, a mortgage broker located right here in beautiful Cave Creek, Arizona, where a mortgage is not a flip of the coin. So if you're looking to purchase or need to refinance, I would like to be your broker of choice as I have access to lowest rates at the lowest costs in Arizona. And if you don't believe me, call me. Here is this week's mortgage market at a glance. Once a month, the government releases the employment situation, also known as the jobs report. No other piece of economic data is as consistently relevant for the bond market and thus interest rates. For most of the past year, the normal correlation between jobs and rates was on hold. That makes sense, of course. Initial lockdowns completely obliterated the labor market, and we've been waiting to see how it would recover and how it would be reshaped ever since. In the past 1 to 2 months, the bond market has finally shown some willingness to react to economic reports. Notably, last month's exceptionally strong jobs number put obvious upward pressure on rates. Now, because of that, anticipation was high for this week's report. Indeed, there was very big reaction. Economists were expecting the economy to create nearly 1 million jobs, but the actual number only ended up being 266,000. That makes this one of the biggest misses in history on this report. Bond yields did the logical thing and moved immediately lower, but then retreated nearly as fast. On the way back up from their lowest levels in months, 10-year yields tried to recover, but were met with resistance at the 1.53% level, the same floor that rejected the rally attempts on several occasions in mid-April, as I showed in previous videos. Now here's a chart to help better illustrate the play-by-play that happened on Friday. The blue line shows intraday movement of 10-year yields. The big vertical drop coincides precisely with the 8:30 a.m. Eastern Standard Time when the report was released. Now keep in mind the line on the following chart doesn't dip below 1.53% because it's an hourly chart and yields were back above 1.53% by 9 a.m. Eastern Standard Time. In considering the previous chart, one positive counterpart would be the fact that most of the week was spent with yields moving lower. The news is even better for mortgage rates, which have been able to do even better than their treasury benchmarks as 10-year yields and mortgage rates normally move in relative lockstep. This has been happening for more than a month and mortgage rates pushed down to their lowest level since late February. While this may look like a big departure from mortgage rates, the following chart offers more context. The only important takeaway, however, is the correlation that largely has been restored after a complete breakdown in 2020, and mortgage rates will have a tough time diverging too much from their treasuries. As for the most recent bout of divergence, there are a few obscure reasons for it. These include things like unprecedented outperformance on the part of mortgage-backed bonds, the changing shape of the yield curve, and the gradual tightening of mortgage lender margins. Now, on a simpler note, treasuries face a few more challenges than mortgage bonds these days. Friday offered a great example of that as administration officials were quick to lean on the jobs data as evidence that the economy still needs support. In general, the more fiscal support the economy needs, the more treasuries will need to be issued. Higher treasury issuance means more treasury supply, which in turn results in higher yields, all other things being equal. That's not to say markets saw it in that way. In fact, many market participants simply disregarded the jobs number as an outlier in the economic recovery that will continue to produce noisy data. Indeed, this week's other higher profile data painted a brighter picture. On the labor market front, weekly jobless claims hit a post-pandemic low. In terms of broader economic indicators, the Institute for Supply Management, ISM, released its indices that track the manufacturing and service sectors. While both declined slightly from last month, they landed on levels that are still exceptionally strong. Next week's primary focus for rates will be on a fresh round of Treasury auctions. Dollar amounts will be at the highest levels ever. These auctions act as an important gauge of the investor appetite for bonds. Lackluster demand would mean rates need to rise in order to attract more buyers. So stay tuned for that. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you, and that's for sure. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I would like to be your broker of choice. Until next time, take care and stay safe.